Are you too busy running the business to build wealth outside of it? You're not alone. For so many entrepreneurs, it feels like all the time and energy goes into building the business, and there's just not much left over to think about investing, especially in something like real estate. But what if you didn't have to be the landlord dealing with toilets, tenants, and all the headaches that come from one of the most powerful wealth building tools out there? Hey everyone, welcome back to another episode of the Vital Wealth Strategies podcast. I'm your host, Patrick Lonergan, and today we're digging into real estate as a strategy for business owners who want to build long-term, tax-advantaged wealth without turning it into a second job. I'm joined by Lane Kawaoka, a former engineer who transitioned into real estate and has now built a portfolio of over 10,000 rental units worth more than $2.1 billion. He's a 3-time best-selling author, host of a top 50 investing podcast, and the founder of The Wealth Elevator, which helps investors move from overwhelmed and overworked to truly financially free. In our conversation, Lane shares how business owners can take the wealth they're generating inside their business and start multiplying it outside of it through real estate without having to become full-time investors. We talk about how to vet deals, avoid common syndication traps, and what the path looks like as you go from active income to passive wealth. And if you're ready to start thinking more strategically about your own plan, be sure to head over to vitalstrategies.com/tax. Our team would love to help you start building out a personalized strategy that puts more money back in your pocket and get your dollars working harder for you. This is one of those episodes where a small shift in your thinking could unlock a whole new level of opportunity. Let's dive in. All right, I'm excited about our conversation today. We've got Lane Kawaoka on the show. Lane is a former engineer turned real estate mogul who's built a portfolio over 10,000 rental units, totaling more than $2.1 billion in real estate. He's also a 3-time best-selling author and host of a top 50 investing podcast. So thank you, Lane, so much for joining us here today. I'm excited about this.
Yeah, thanks for having me. Aloha, everybody.
Lane, you're the founder of the Wealth Elevator, and you've built a portfolio over 10,000 rental units. And I'm excited to get into multifamily. I think that's a fantastic opportunity for us to get into. But before we get there, I think about our listener. You know, they're an entrepreneur. They're very excited about wealth building. And one of the things that we spend a lot of time talking about is there's really two fantastic ways to build wealth. The first one is building a business, but that can be really challenging. You know, the number of business owners that don't make it is really high. The second way to do that is investing in real estate. And the reason we think it makes a lot of sense is there's really 4 factors that really drive that growth. First is cash flow. People think about passive income with real estate, and that's first option. Second is appreciation. You know, the asset value goes up. Then next is the loan amortization. It pays itself down. And then one of our maybe favorite hidden wealth strategies in there is depreciation. You know, we can, especially if we're a real estate professional, we can accelerate a lot of that depreciation and offset other income, and we can build wealth almost completely tax-free. So I'm excited about digging into these different topics. But when I think about the listener and what the challenges are, is like first it comes up is like I don't have time. I don't have time to go be a real estate professional and dealing with the tenants and the toilets and turnover and all those other things. And then there's maybe an internal question of like, I don't even know how to do, a real estate deal. I'm really good in this arena, but not that one. And then finally, it might be philosophical in the context of like, geez, I see all these people making tons of money in real estate, and it's just it's not fair that I can't get into that game. So thank you so much for joining us. If we can get into just a little bit of your background, can you tell us how you went from former engineer to real estate mogul?
Yeah. Thanks for having me. So my story, I call it the linear path. I was taught to go to school, study hard. Was also taught to be pretty frugal with my money. Graduated college in 2007 with a industrial engineering degree. Eventually got a civil engineering master's, but started to work as a construction supervisor for a Fortune 50 company, and just taught to do the old 401k, max out the 401k, and then also buy a house to live in, which I don't necessarily think is the best idea for a lot of people out there. But I was brainwashed, right? Like we were all by my parents, and bought that house to live in. But because my first job, I was traveling all over for work as a young professional. I was only on Saturdays. I just decided to rent it out on a whim. And, those 4 things that you mentioned, right? I was hooked. That was 2009. Bought another duplex a few years later. And then several years later in 2015, I had 11 of these little rental properties. And between then and then, the first few units were in Seattle, Washington, where I lived at the time, so I could feel it, touch it. But then I went out of state, so had 5 rentals in Atlanta, 4 in Birmingham, 1 in Pennsylvania, 1 in Indianapolis. So I was doing the remote landlord thing up until that point, and that was kind of where I became more of an accredited investor by SEC standards, $1 million net worth or greater at that point.
Yeah, I love it. This is great. So, can you tell us how you went from? Because I think there's a big jump that needs to take place from because it can be really slow. When I put 20% down, I buy something, it creates a little bit of cash flow. But unfortunately, I figure out that pretty soon my cash flow goes into a major repair, like a roof or something along those lines. It can be hard to accelerate that growth. How did you go from acquiring these to really like the level that you're at today?
Yeah, I think up until this point, I was just buying these properties somewhat turnkey, right? I wasn't doing the buy rent rehab. I wasn't flipping houses. I wasn't wholesaling houses. To me, that's what you all do when you're on the kind of the starter level of what I call the wealth elevator, right? In the basement
Yeah.
level, a lot of guys don't have, they don't even make $50,000 a year. They're trying to get rich quick, so they see on HGTV these flipping houses shows.
Yeah.
My formula up until that point was just 20% down payment. Like you said, I was just a good saver with my money. But I got up to that point, 11 rental properties, which created maybe a few grand of passive cash flow a month after all expenses. And it hit a sticking point where, first, you can't get more than 10 Fannie Mae, Freddie Mac loans in your name. You can get 10 in your spouse's name too, so that's a little trick. But you don't want to own rental properties, right, once you get a certain point. With 11 rental properties, I had professional property management, but I was having maybe an eviction or two a year. Some kind of big catastrophe happens every quarter. And this with 11. And, most of my clients aspire to more than $10,000 of passive cash flow a month. So you have to triple that exception rate at least. So now you're talking about an eviction every other month, like something happening every week, pretty much, basically. And it's just not scalable. And then, when you own rental properties, even through it like an LLC, today we work with folks and we do the irrevocable LLC or irrevocable trust. So there's a little bit more asset protection. But even if you're buying these things with an LLC, like you're still on the front line to getting sued on these things. You got like 30 tenants in this case, right? So I was searching for, there's probably something next, right? And what does any smart kid do with an engineering degree? When you're buying single family homes, you buy multifamily, duh,
Yeah.
right?
Yeah.
So I kind of was searching around. Luckily, I was kind of still young at this time. Was kind of in my early 30s, and I just happened to meet up with other accredited investors, and this is why the power of networking. But unfortunately, you're not going to find any of these guys at the local real estate club. Those you'll find just like the lower net worth guys trying to flip houses. But I went to a lot of national conferences and joined a lot of groups and networked like crazy. Because I didn't have any kids at the time and nothing better to do, basically, right? It took a lot of time.
Yeah.
And what I realized was there were a lot of people just in my shoes, right? The quiet wealthy who had $1 million, $2 million net worth or greater that had a bunch of rental properties, but in the genesis of selling those off to becoming a LP, a passive investor, limited partner in a larger syndication where we have a group of 50 or 150 investors could take down a 200, 300 unit apartment complex. And the cool thing about that, just like when you're owning a rental property yourself, you don't have all that Wall Street bloat like a REIT. Like a REIT is just crazy fees and expense ratios and that type of stuff. In this case, with the syndication, you have a general partner that takes on the signing up of the debt, the liability, but you get pretty much direct access to the deal. They have carried interest, of course, but hey, that's part of the joint venture, essentially. And I got into this world and I was sold, right? I mean, I think the hard thing, and we can talk about later, is like work finding the right people, vetting deals. But from a high level, it's like, yeah, why wouldn't anybody want to do this, right? And the tax benefits are stronger here.
Yeah.
That was kind of my transition around 2015, I would say.
Yeah. I love this, and I think we followed a similar path. We had portfolio of small single family, multifamily, and I remember we went to this conference, and it was expensive to get there, and it reshaped our thinking as to what was possible. And we were like, oh, okay, we've got the background. We can go put together one of these bigger deals, and we found somebody to partner with, and we put in a lot of sweat equity and not a whole lot of cash, and it was interesting to just see how that opened us up to more of those opportunities. And you touched on I think a very, very important piece. Two things I want to highlight. First is, you can't just look at every opportunity that comes down the line as a real estate opportunity, whether it's a REIT or, if you're an accredited investor, there's some PPMs out there, private placement memorandums that, people put together like, hey, you can put some money into these things, and it'll be a great deal. I've seen so many abuses on both of those side of things, where the sort of REIT, sometimes syndication deals are so bloated with fees. They have so many layers of affiliates in there that it's like they're making all of the money along the way. And if any trickles out to the investor, great, but they don't work out so well. Or the operator had some luck and they're trying to scale this thing up, and they've got a high sort of management fee to just sort of run this process. But at the end of the day, they can end up with all of the money and the deal goes bad, and it's like, well, I'm sorry about that. So I think there's absolutely something to be said to just vetting and knowing who you're dealing with and when you're getting into deals, because it's I think it makes or breaks the opportunities. Finding somebody with a proven track record is a critical piece. So this is great. So can you talk us a little bit? You've touched on the wealth elevator. I'm excited about this concept. Can you give us the breakdown of, going from how do we start at bottom floor and sort of work our way up to really accelerating our wealth as time goes on?
Yeah, yeah. And maybe I'll start with like the whole idea came about, like there's a lot of good books out there, like Dave Ramsey, Susie Orman, but these guys write books made for the masses, right? A lot of guys in that basement level of what I call the wealth elevator. This would be the floor like your nephew would be at, basically, right, out of college, or somebody who makes less than $50,000-$60,000 a year, not yet any net worth, maybe under $100,000 net worth. I was lucky enough because I graduated with an engineering degree and not too much student loans, that I was kind of put in that first floor of the wealth elevator where you're a non-accredited investor. Your net worth is still under $1 million. You don't make an extreme amount of money over 250. So you're at what I call this is kind of the adolescence of investing, right? You're stuck. You're not getting access to good syndication deals, and even if you did, it would be with unproven operators, guys getting started. But this is what I did from 2009 to 2015, and this is a frustrating part. Like, this is not a get rich quick scheme. This takes a lot of years, and it's like watching grass grow. But and you're basically limited to how much you can save. Most of people in this zone maybe can save 10 grand. I was able to save 50, 100 grand, so I was able to expedite through this level. But like I said, when I started to meet other accredited investors, started to learn this trifecta of strategies where you're investing directly in alternative investments, cutting out the middlemen, the tax strategies, and then infinite banking too on the side. And this is kind of what is the formula for the second floor of the wealth elevator. These guys are accredited investors, so you either make over $250,000 a year or net worth $1 million or greater. Now, I know we're talking to a lot of business owners out there. Likely if you have a revenue of over $1 million, you're probably in that second floor of the wealth elevator. And this was the concept that, like there's a lot of financial advice out there, even like Rich Dad Poor Dad, right? Rich Dad Poor Dad to me is mainly written for people in the basement and the first floor. Plus, there's no actionable advice in that book. Great mindset stuff for sure.
Yep.
But it was my approach. And in the book, there's like in the middle of the book, there's like a tear out table, right? A flow chart, because I'm an engineer, of course, right?
Yeah.
Like the first step is like figuring out where you are, right? Because certain things apply to certain places on the journey. And as opposed to taking the approach of going on TikTok and like getting all this random financial advice, certain financial advice is, is more applicable to certain places on the journey. So it's important to understand these different levels. Of course, there's levels beyond that, but those are kind of the, I think the second floor for people listening today is kind of the on ramp most people get on here.
Yeah, I love this, and I think you're so right on a lot of the advice out there. It's generated for the masses, and it really doesn't have anything to do with wealth building. So I think that's
Yeah,
I
it's
think
more
that's great.
strategies of like get on broke, right, in the basement, even the first floor.
Yeah.
And that's where like, responsible people that have been at this for a bit,
Hmm.
amassing net worth, it's like, well, there's no book written for people on the second floor and then the third floor and then the penthouse.
Hmm.
And then, just kind of like I have a saying like, act your wealth age. You know, I'm sure you and I aren't going to the club at 1:30 2 a.m. in the morning, right? Like those days are gone.
Yeah.
Just
Yeah.
like certain things, like, like I'm not gonna not have my $6 latte. Like that's just
Hmm.
not gonna happen, right? Like
Yeah.
that's silly.
Absolutely.
But there was a time where I would go to like FinCon and hang out with all
Hmm.
these super cheap frugal people, and like these are the things that we would do, like credit card hacking, travel hacking, right? Like that's
Yeah.
cool when you're in your 20s.
Right.
But when you have family, like most of my clients today are in their 50s typically.
I love this. So I'm very interested in talking about sort of the opportunities you've created, because I look at the we'll call it the high net worth individual, the entrepreneur. They are so busy building wealth inside of their business, and exactly like you said, our clients are net take home north of $1 million a year, and so it's like they are not worried about the $6 latte. They're taking the direct flight 100% of the time. They don't care what the cheapest option is. So I'm curious about what are the opportunities out there? If somebody is going, Lane, this real estate thing sounds amazing, but I don't have time or energy for that. Can you talk us through a little bit about what a wise way is to get invested in some of these deals versus going out and taking 100 grand and putting it down on a single family or duplex type property?
Yeah, I mean, we talked about the single family homes. I mean, it's just not scalable that way. And then the legal liability, right? Especially for people with $1 million or greater, you're actually a bigger target to get sued. Where in theory, if you're less than that, no one really wants to sue you. You're broke,
Mm-hmm.
right? There's nothing
Right.
really to get there. So you start to get into the syndication world where the tax benefits are stronger with bonus depreciation there. But the hard part here is, well, how do I get access to these country club deals, right?
Mm-hmm.
With this proverbial country club, right? These are all private deals where you have to go and seek out the operator. And that's what's hard, right? A lot of this is like people try and play the fake it till you make it game.
Mm-hmm.
I've been in dozens and dozens of deals as a general partner, lead sponsor, maybe 100 plus as an LP myself. I think the first thing I tell people is like there's a spectrum of operators in terms of experience. You have institutional firms, these are the guys who have done billions of deals. And then you've got newbie groups,
Mm-hmm.
guys that haven't yet met $1 billion assets under ownership, right? And on the spectrum, you've got one's going to be a lot more expensive in terms of fees and splits. One's you might get like 80-20 splits for all we know, but you
Yep.
definitely don't want to work with, or I wouldn't. Look, I wouldn't. You guys can make your own decisions, right?
Right.
To me, what I try and look for are guys kind of in the middle, right? The middle market, right? Good fees and split structures, where there's a good kind of symbionts structure between the GP and the LPs. But you definitely want to find a guy who's not in his first dozen or couple dozen deals, right? Because I've been there, right? Like my first 50 deals that I went into as a partner, I would probably say maybe a few of those I was like, oh, shoot, maybe I shouldn't have invested with that person or that deal.
Yeah.
But that's part of the game. And I try my best to like, I think that's my role here is like try and get people past that step as much as possible. If you played the game Oregon Trail, like most of us have, right? We're that age,
Yeah.
we're aging ourselves here. I was never one to just charge across that river by myself. I was always find a guide, right? And to me, it's kind of two parts here. You analyze the people and then you analyze the deal for what it is, not the returns profile, but what are the assumptions in the model that the operator is making to see, are they being audacious with some of their projections, or are they being conservative? And just to name a few, like, what is their full occupancy assumption? Better not be 95% occupied or more. That's way too high. That's not possible from an underwriting standpoint. What is the reversion cap rate? What do they assume the market's going to be selling for in the future? And then you look at things like fees and splits, right? That typically range between 1 to 3, 5%, right? Like it has to line up based on where this operator is in terms of the experience spectrum.
Yeah. Yeah, Lane, and I think you bring up an important point too. And this is a sort of a fine detail when I look at investing in syndications, right? Like I can invest in a particular deal, and I can look at that deal on its own, or I can just put my money into a fund, right? And I'm just going to trust that the manager of that fund is going to pick wise investments. I think you just highlighted the importance of looking at a particular deal, so I can analyze the opportunity, on its own, and make sure that the GP, the general partner that's putting the thing together, is looking at it with clear eyes. Is that a fair assumption that you like the single property versus the blind pool?
Yeah, I mean, I like to do single asset deals as an investor myself too, because I have the ability to underwrite it and I want to look at the deal. Where I guess like some advice you hear out there on the internet is like, well, just invest with the operator, right? Pick the jockey, the horse and the jockey analogy. And I don't entirely agree with that. Like, I get it. Look, if you're an investor and you don't know what you're looking at, then yeah, pick the jockey. I mean, that's what I do when one time I went like horse race gambling. I didn't know what I was doing. I'm just gonna bet on the cool horse, right?
Yeah.
And the cool thing about real estate is in real estate, the horse, which is like the deal. If you underwrite the deal, it's actually, you can do pretty well. Where I think when you're investing in businesses, like we also do some private equity investments ourselves, it's like flip-flop. The operator is more important than the jockey. And that's kind of why my approach is like, all right, before I even look at the operator's, past history, I'm just going to look at the deal first. Because if they're underwriting with a reversion cap rate that's lower than an entrance cap rate, they're already being way too aggressive there. I'm not even going to look at the deal. So there's a few things that I kind of stick to, is like maybe taking an 80-20 approach to just cut down the time, because you want to go through a lot of these deals, right? And you don't want to be jaded at the first deal, like this amazing deal. But I think I kind of take a little bit alternative approach, but because I know how to take the P&Ls and the rent rolls and the financials and do my thing. But I think some of the advice here is predicated on people who don't know anything, which is, I think, short selling a lot of people out there, smart people. And then they say, well, just invest in the jockey, the good guy, right? But then I'm like, man, like on the lower rungs, when you work with people that are under $1 billion of assets, like these training groups that these guys go to, and then I've been to some of those conferences myself, right? These fake conferences, non-industry conferences, where they teach you more about like showing a good social media presence and getting interviewed on podcasts than like operating a freaking deal. It's silly, right? I mean, I guess part of it too is like the only way you learn about doing this is operating deals like we've had, and ups and downs. But that's unfortunately like the world of like newer operators, right? And for new investors, it kind of, man, it just makes things really tough, I think.
Yeah, this is great. So I'm gonna go back and highlight a few things that you mentioned. So for somebody that doesn't understand sort of real estate lingo, I want to talk about cap rates for a second. Okay, so if a building is producing an NOI, net operating income, of $1 million, okay, and I buy that property at a let's say a really low cap rate, like a 4 cap, okay? That means I'm getting 4% on my my money if I pay $1 million, or excuse me, if I pay cash for that building, it means I'm getting a 4% rate of return on my my money when I'm at a 4% cap rate. So that means my price is going to be relatively low, right? Lower cap rates means generally higher prices. And then if I'm going to the future and I'm looking at selling it, I should probably be using the same number, right? You know, what I'm buying at and what I'm selling at, you know, we're going to assume those cap rates are the same. I think you were highlighting, like, if I'm buying at one cap rate and I'm selling at a lower cap rate, you know, it means my price is going to be higher in the future, and that's probably not a fair way to look at doing that deal. So I think that's an important piece to highlight, because I think there's a lot of wisdom in that. And I think the thing I want to point out is, going back to your point on finding the guide to help you cross the river in the Oregon Trail, having somebody that can come alongside you and look at these deals and analyze them. Like, we do that all the time with our clients. It sounds like you're helping, you know, the people that are looking at your deals analyze those things as well. And I think that's great, because most people see the spreadsheet, they see the pro forma, and they're like, I have no idea what all these figures mean. I don't know what you know, the debt service coverage ratio should be or shouldn't be, but those are important factors. So I don't know if you have anything else to highlight there, but I think that's
a bunch of things. I mean, debt service coverage ratio should always be 1.25 or greater, so you're able to hit your debt service with a little bit of buffer there. But you know, adding on to your discussion of cap rates, right? Cap rates are what some people use that as sort of like, well, how good is your machine rolling at, right? How much money is it making? What I'm talking about at upfront due diligence is, you know, in like, you know, you have a spreadsheet, right? Like, just like your guys' businesses, when you guys are trying to sell your business, it's a model. It's a silly spreadsheet. It could be pretty advanced, right? As most of these things are, because it's just a template, of course. But to me, the biggest number sell on that spreadsheet in multifamily real estate is the reversion cap rate sell. So what this thing is like, it's an assumption of what the heck this asset is going to trade for in the future. So you can buy a Class B asset in Dallas, for example. You know, I'm going to take a stab at this because it's been we had the correction these last several years. But let's just say it's a 5 cap today.
Yep.
And you know, in the underwriting, you want to usually assume that you're selling it into a crappier market. Imagine that. To be conservative. So an operator might use his underwriting a 5.5, right? So increase what the assets are trading for, or what we call the prevailing cap rate. What are these same assets in this submarket and what this asset is trading for today? And you want to increase it to be a little bit more conservative. So, you know, an investor, an LP, doesn't have to be super sophisticated. Could probably look for the sell on the spreadsheet or in the underwriting, or just ask, you know, what is these assets trading for today? 5.5. What are you guys assuming that's going to be trading for in the future? Prevailing cap rate, or reversion cap rate, or exit cap rate? All these three things mean the same thing. 5.5. Now, if they say it's 4.5, that means they're being more aggressive, and that's a big red flag, for example. But you know, this is something that, like, say they said it was a 5, so they're assuming they're selling in the same market. That might but I look at the deal and I'm like, well, let me down regulate this to be, you know, the same standard of conservativeness as anybody else that underwrites it as the industry standard. Well, maybe when they put out the deal, it was going to be 100% return in 5 years, but when I normalize it, it's really like 65%. You probably wouldn't invest in the deal. But that's where I'm like, a lot of new investors, they just take what's on the PDF, but you also have to regulate it based on what the assumptions are. And that just that one cell in the spreadsheet, 0.5% one way, just fudge the numbers 30-40%.
Yeah, I love this. Hey, real quick, if you're listening to this conversation and thinking, this is exactly the kind of stuff I need to be doing, but I'm not sure where to start, then let me point you in the right direction. Head over to vitalstrategies.com/tax. My team and I would love to help you build a proactive tax strategy that keeps more of your hard-earned dollars in your pocket and positions you to grow real wealth outside of your business. This is where smart tax planning meets high-level strategy. So whether you're looking to reinvest, expand, or just stop overpaying the IRS, we've got you covered. Again, that's vitalstrategies.com/tax. Go check it out, and let's start making your money work harder for you. All right, back to the episode. So another thing that we think about when it comes to real estate, we've talked about cash flow. Cash flow drives the value of the asset. A lot of times in real estate, there's mom and pop operators. They've been doing it for a long time. They're sort of tired, and there might be some opportunity to sort of fix that cash flow. How much of that are you looking for? Because I know you highlighted like a Class B property. If I had to pick an asset class, Class A is like brand new, just built. Higher net worth people are living in those properties. We'll say Class C is very run down. It's tired. Probably subsidized housing, that type of thing. B is like, hey, we've got our middle class folks living here. There's generally some opportunity, kind of an older building, might be 15, 20 years old. And feel free to correct anything there that I just said. But how much opportunity are you looking for to like fix the operations or cash flow to really drive the value up?
Yeah, I mean, our strategy has kind of changed over the years. Like when we first got started doing this, we'd buy a lot of like crappy Class C.
Yeah.
Normally the age, I think I go off of age. So like
Yep.
1975 and older probably be Class C. It's like 1960s properties. Probably what maybe a lot of us lived in college, right? Like that kind of garbage. We would buy a lot of these like smaller units too, but they'd be bigger turnovers, like bigger renovation bumps. And these, we made a lot of good money with this, but like during the hold, like, man, it was just difficult working with the clientele, as you could imagine. Like, some of these deals we'd have like 80% occupancy or economic occupancy, which means maybe the property's full 100%, but you have 20% of the people as deadbeats not paying rent. I mean, that's just how it is, right?
Absolutely.
That's just how it is in the Class C world. Later, we stepped up to more Class B, nicer properties, and then even getting into the A's and then developing, right? That's even the ultimate nice, better clientele. But, as we kind of went along, we kind of went a little bit more lighter on the value add side as you go to Class B, right? So renovation budgets in the Class C side are a lot deeper. So maybe $10,000, if I normalize it just for the same market, like Texas, for example, right? Where the Class B side, there's less things to do. As we've kind of went along, we've kind of gotten more conservative in the undertaking in a way. But I'm not going to say that that's the right strategy. It's just like what the operator, what they do. I know I'm good friends with some people who take down very hideous projects, and they look for things that are like less than 50% occupied. And then that's another thing. We try and stay to properties that are 85, 90% occupied or greater, so we can get the good financing on the entrance. I think as we move along, I think we're kind of following that trend. Like we don't want to. You can make great money when you work with more hideous things. But that's kind of been our company trend to kind of get away from that as a time being.
And just to highlight that for just a second, you can absolutely make more money. You can also lose more money. And the amount of time and energy that goes into those opportunities is just greater, and the stress level is greater. And so anytime you're doing construction of any sort, and we've done some ground up development stuff too. Anytime you're building something versus coming in and fixing an already operating cash flow opportunity, there's just more risk involved. And so especially when you're cleaning out whole sections of the property to remodel those to get it done efficiently and effectively, like it just brings the risk level up and the stress level up. And so, as we just generally see as investors, one of two things happen. They either mature and they go, okay, I'm really good at this thing right here, right now. I'm just going to do more of this thing. We're going to scale that thing up. Or they go, oh, I made some money here. I'm going to make my life a little easier and move up sort of class rank in property and not have as much, I'll say, stress in my life. So, I think those I appreciate your approach. It seems like it's the wise, mature thing to do. So
I mean, it's also is like market dependent too. Like I think like what we're seeing now, the lower end properties are kind of taking a beating at this point, just because just to give people a little bit of history lesson. In 2020, we had the pandemic, interest rates went pretty much down to zero again, and you had this like free for all cash. So all these new developers, ourselves included, we built a couple properties, so we're guilty as this as anybody else. But all these new builders started to build from 2020 to 2023, and buildings take a year or two to come out as babies, right? Babies take 9 months, buildings takes a couple of years. So right now they're all flooding the market right now. So you have a lot of new inventory competition, so that's lowering the price on the class A. Normally when you launch a new property, you have a concession of like 1 to 2 months of free rent. Now it's like 2 to 4 across the country. So what this is doing is absolutely beating up the class B and C properties at this point. Now, this is just a temporary thing, right? But this is just an example of all these kind of micro trends that are happening amongst the big thing. But, where you start at the top, right? Like all this multifamily, yeah, it makes all sense, right? But there's micro trends that kind of happen based on like, free for all money in 2020 to 2023, creating all these building babies now. And then, this will work its way through the system. 2026, 2027, things will get back to normal, and you'll have that elasticity and going back to the B's and C's. But yeah, I mean, you said it earlier, like the term recession proof, like, I mean, nothing's completely recession proof, but the theory is, in tough times, people need more value-based living options. So rents $800 to $1,100 rent. And that's where these class B and C properties reside. But you have these micro trends that kind of occur.
yeah, yeah, I love this. So I want to take this a couple different ways. Let's talk about economic downturn. And when we think about the universe of investment opportunities out there when it comes to real estate, I've got commercial, industrial, office, multifamily. Okay, and I'd like to get your opinion, and then we can sort of have a conversation around which of those asset classes makes the most sense if the economy starts turning down. Because I think there's one thing I'd like to acknowledge is we had our last recession in 08, 09, and that was 17 years ago. Economic cycles are generally 10 or 12 years. And so I feel like we're a little bit overdue for a recession. Who knows if the current sort of disruption in the economy with tariffs and that type of thing is going to be the thing that kicks us into that, or if it's going to be something else. But what I do know is we do go through economic cycles, and whether one's coming, this year, next year, or the year after, I don't know, but they do tend to come. I'm curious what your thoughts are on, multifamily versus some of those other asset classes and how they can weather a storm in a recession.
Yeah, I mean, commercial real estate, so multifamily office absolutely got killed the last 2 to 3 years. It went down 20 to 30% off the peaks, worse than 2008. And the reason being, single family homes didn't really kind of stayed strong. The reason being is with single family homes, you have 30-year mortgage cycles, right? So prices, demand drops, people don't sell because they don't have to. Where in commercial real estate, most people will use bridge debt on value add projects. And when the demand drops, like how it did, like we stopped buying in summer of 2022 when interest rates started to go up. And that's where the demand dropped. But, people had to transact because the loans expired, right? They're on shorter terms. So that's why you're seeing a 20, 30% drop off the peaks, which makes commercial real estate very, very appealing today. Right. So if you're a contrarian investor, you need to take note of that. But the problem, here's the problem with like why we haven't really bought anything in our space yet is you need two things to make a deal work. You need the price, which is what we have, right? The lower price today, but the debt isn't comboing to make the deal work, right? So like today, I used to get 75% leverage on these projects. Today, that's like way less, like in the 60s. Yeah. And that just kills my numbers. Like I just have to bring a lot more to the table. I can get the economics want to kind of pull the trigger on a deal. So I think long term, and we can come back to this, long term, I like real estate, multifamily for sure, but at least from what I see, like the Fed rate's not going to come under 3.5%, maybe in the next 5, 10 years. So I'm assuming it's going to be like this for the long haul. And if people don't believe me, you can go to the Chatham financial curve. That's probably the best indicator where interest rates are going to be. The era of free money is over. So from that perspective, real estate lost a big trade wind to our backs. And this is why we've also started to look at investing in private equity deals, and kind of getting away from real estate a little bit. Unless, of course, every individual deal is different, right? But I'm just speaking in terms of generalities.
Yeah. Yeah, I love this, and I think there's a few points that I've sort of seen through. We lived through 2008, 9, 10 with the sort of recession taking place, and one thing that we noticed was there's sort of two factors, and location matters. Where you're investing, I think, is important. If that economy is strong, it helps. And then the second factor was we had some business partners that had industrial property warehouses that were sitting vacant. It didn't matter what they did with their leases. There was just nobody to fill that space because the economy wasn't producing enough products to make that asset viable. Same thing with some retail and office space. It's like, look, if businesses are not thriving, they're not opening up new storefronts, and so that can be a challenge. You can, again, move the rent to zero and there's nobody to move in. Where multifamily, you drop the rent 10%, somebody's moving into that property, and you can at least keep your cash flow going, which we like. And you highlighted that too. When times are good, people are moving up into residential properties like B. They may be moving out of the C into the B, and when times are tough, they might be moving out of the A into the B. So it's we like multifamily for those reasons. And I also am curious about your comment on private equity, because I feel like private equity and real estate investment are very similar. They are hyper focused on cash flow and how is this deal performing from a cash flow perspective. And so I don't know if we want to wander too far into that, but do you want to give us your thoughts on the opportunities in the private equity space?
I mean, I think we're talking, when I mean private equity, it's like y'all brought owning your own businesses, right?
Yeah.
This can be a variety of different things, but I think the hard thing with real estate, and this is I know I'm talking to business owners out there, and everybody thinks the grass is greener on the other side. Maybe I'm making I'm on the real estate side, looking over at PE side, and vice versa, the listeners, the opposite. Here's the crappy thing about real estate. As I mentioned earlier, interest rates aren't going to come back to what it was. That's number one. Number two, we've seen taxes and insurance just skyrocket on these things. I've had properties where it triples. And the funny joke is, well, what do you do when that happens? Yeah, you attest it, you get a lawyer, blah, 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 but
right.
You pay it. You pay the damn thing because you have to.
Yeah.
They're uncontrollable expenses. And all the good things about real estate, the bad things is there's not that many levers that you can pull, right? It's a very simple business plan. There's not much levers you can do. Whereas you guys out there are owning businesses, it is a lot more risk. Don't get me wrong. Where with real estate, it kind of stuck. I don't want to be argumentative, but to add a counterpoint to what you just said earlier, you can just lower your rent 10% and get some people in there, but that's a race to the bottom. You do not want to do that, because then you're just going to get garbage tenants who's going to jack your property up 12 months, 18 months down the road. You're probably going to have, not probably, but just a higher level of evictions that you're just going to kind of kick the can down the road with that. So you can't play the game of just, dropping it. You got to keep it where the market is at so you can attract the better tenants. Because, again, I'm talking to business owners out there. You have employees. You guys know that the good employees is a rarity out there. No different than tenants. There are maybe you could say that most of them are really bad and we need to stay away from them. But the way to do that is kind of keeping your rents right at market and then being really good on your standards for letting the right ones in, doing
Hmm.
your background checks. But like that, this is kind of where it's like, well, sure, you just confused me, Lane. Like, there is
Yeah.
no right or wrong way of doing this. I think, like, look, I had my real estate portfolio. I wrote a good way from 2009 to 2022. I had
Hmm.
90% plus of my net worth in real estate. And that wasn't, I learned a lesson, right? And I'm always going to have real estate. Don't get me wrong.
Yeah.
I've bad talk real estate for the last 5 minutes, but I still like it. I understand it. I can underwrite it. But I'm looking more of like a diversified approach is kind of what I'm looking to do personally. Now, everybody's in a
Yeah.
different situation, different net worths, different times in life. I'm still in the growth stages myself, but coming back to real estate, they're not making any more of it. We're in a population growth country. Some people argue
Yeah.
with that, but then I would say, well, when we go after workforce housing is really my investment thesis. And the reason being is the rich are getting richer, the poor are getting poor, the lower middle class is getting bigger. The middle class, where maybe I started, is shrinking and they're becoming the
Hmm.
lower middle class. And we'd sure like to house them in our apartments.
Yeah. Yeah. I love this. And I totally agree with you in the context of turnover and trash tenants are not anything you want to deal with because it's so expensive. It might be short-term win, but lowering that rent 10% might cause more problems than it's worth. So I think this is great. Lane, this has been a fantastic discussion around real estate as a wealth building tool. We've dug into some nuance there. If somebody's interested in learning more about the wealth elevator and sort of getting plugged into you and everything you've got going on, what are the best ways for people to do that?
Yeah, they can go on Amazon, just type in the Wealth Elevator. I'm sure it'll pop up. It's got at least 100 reviews there.
Mhm.
If they buy it and they leave a nice review and email it to us, we'll hook them up with the PDF and the MP3 version. I
I
know
love it.
myself, I don't read too well. I just listen to things these days. So
Yeah.
I think there's
Yeah.
Audible. There's an Audible version too. I sat down and recorded that myself. But
Great.
yeah, I would say the first part of this is like figuring out where you are at, uh,
Hmm.
figuring out what your cattle grade is, and starting from there. You know, always would like to have calls with people, kind of pointing them in the right direction. For some cases, these retirement accounts don't make any sense. Sometimes it does. It
Right.
depends on where you are in this wealth elevator journey.
Yeah. Yeah. No, I love this. So first step, figure out where you're at in the map, and then from there you can create a plan. Um, I also have been impressed with all of the content you've got on the wealthelevator.com. I think there's a uh, fantastic resource there, so people can go check that out. We'll have links to that in the show notes along with the book. But Lane, this has been great. When I think about building wealth, you've highlighted a few key points, and I think it all starts with um, really a basis in cash flow. Whether it's a business or a piece of real estate, every dollar that we can increase that cash flow increases the value of that asset, generally by a multiple. And so we think it's the best way to build wealth. And you can build financial security doing some of those things that you discussed early on with Dave Ramsey and Susie Orman. Like they're like in the basement level and help you get unbroke and sort of build up to a point where you're portfolio can support your lifestyle, but that's not really wealth. That's not impact type wealth. And so I appreciate the good work you're doing here on really getting these principles out into the world for people to learn what it looks like to accelerate that process. And we think about what happens if they don't, right? If I just keep doing what everybody taught me to do in school, I go to work, get a good job, start putting some dollars away. That can be a frustrating process because it doesn't ever feel like we're really ever getting ahead. So I think this is great. Anything else to add before we wrap up?
Yeah, I think a lot of people out there, they probably run businesses that make over $1 million in revenue. If obviously the first thing to do is like work to sell and exit the business, whether you do
Hmm.
a partial sale, stay on board, or I think the goal at the end of the day, even for my clients, is to get the $4 or $5 million net worth, which is somewhere on the third or fourth floor of the wealth elevator. There are things past that for sure, but when you go over 10, $20 million plus, for sure. But to get to that first rung of 4 to 5 million, that's enough that you can retire off a 4% withdrawal rate and give a couple million to each of the kids. Any more might be overkill from spoiling kids from that perspective. Although it's the generation three
Totally
that you
agree.
got to worry about more. But I think I always think it's the sprint getting to that point. And my attitude and style is like, once you get there, just relax and trade trade money and time for experiences at that point. But I think that's at that point, that's I think where a lot of people are pretty close to probably listening at this
Yeah.
point. And if you want to keep growing the wealth after that, then yeah, sure, getting deal flow, analyzing deals, going into private equity makes a lot of sense to stay on that road. But for most people, that may not be your path. You may just want to put it into life insurance or T-bills and chill in a way.
Yeah.
But get to that 4 or 5 mil. I think that's a big stopping point for a lot of people.
Yeah, I love it. And that takes a fair amount of work. You really kind of got to put your nose down and grind to get there. And you highlighted some key points too about keeping your expenses as low as possible, so you can allocate more dollars to sort of that net worth column. I think there's a lot of wisdom in that too, and that's an unsexy answer that most people don't want to hear, but it's very true. So, Lane, this has been a fantastic conversation. I do appreciate it. Again, I encourage everybody to go check out the book, The Wealth Elevator, and you can also go to thewealthelevator.com and see everything that Lane's got going on there. But this has been great. Thanks. Thanks so much for tuning in to this episode of the Vital Wealth Strategies podcast. I hope you found a ton of value in my conversation with Lane today, and that it gave you a clear picture of how you can start using real estate to build real, lasting wealth outside of your business. If this episode sparked something for you, I'd love for you to share it with a friend or colleague who could use this kind of insight. You never know who's one conversation away from a breakthrough. And if you're ready to start building your own strategy and taking action on the ideas we talked about, head over to vitalstrategies.com/tax. You'll find resources there to help you take control of your tax situation, invest smarter, and keep more of what you earn without adding more to your already full plate. And remember, you're a vital entrepreneur. You're vital because you're the backbone of our economy, creating opportunities, driving growth, and making an impact. You're vital to your family, creating abundance in every aspect of life. And you're vital to me because you're committed to growing your wealth, leading with purpose, creating something truly great. Thank you for being a part of this incredible community of vital entrepreneurs. I appreciate you, and I look forward to having you back here next time on the Vital Wealth Strategies podcast, where we help entrepreneurs minimize their taxes, master wealth, and optimize their lives.